swaps are useful as a hedge if you're actually like someone borrowing debt on real estate, right? But also people use swaps as just an investment tool, and they can play the swap contracts to their advantage. I mean, because let's say the bank on the opposite side of the swap, they're in it not to be a nice guy and say, you know what? Don't worry about your floating rate. I'll pay you a fixed rate, right? They're doing it to make money. So the way that they make money is they assess, okay, if I'm going to take Rob's floating rate burden, I have to figure out what fixed rate I'm willing to pay so that I can still make money. And so how do they do that? Well, they analyze the future. They say, where are floating rates going? Because that's what I'm going to be paying. So like today, for example, if let's say floating rates today are 7 and then projected in a year to be 6 and then another year to be 5 and then another year to be 4, they could go, you know what? I know the floating rate today is 7, but I'm actually willing to swap and pay Rob a fixed rate of, let's say, 5 today because I know that I'm going to float down to 4 eventually. But you know what? I need to make a little money and I need to cover myself a little bit. So I'm going to offer 5.5. So I'm going to lose money now because I'll be paying his floating rate at 7. But as it floats down, eventually I'll make money. And hopefully over the average term, over the term of the swap contract, which let's say the swap contract is 3 years, but the fixed rate provider, will make money. So that's the essence of swaps. And so there's always spreads between the US Treasury yields and swaps. So, like for example, if you look at the 10-year US Treasury yield of, let's say it's 4.2-ish today, we need to see where are swaps today, and the corresponding swaps. And I believe Pensford has the swap prices. They do. So you can see this is really crazy stuff. 10-year Treasury today, right now, is 427. The 10-year swap is 374, all up and down the curve.